Saurabh, guess what? Dinshaw Irani also joins us, and yeah, he is smiling. Yes, yes. He's smiling because he did not have IT stocks for last 1 year. Saurabh Mukherjee is buying IT stocks for last 1 year. He's also smiling. Dinshaw, what do you have to take to Saurabh Mukherjee? Just gave us a 2 minute, very logical and a very, methodical way in which why you should buy into IT.
Oh, no. I won't be buying your IT today. So that's out of the question right now. So we've been calling it out, Nikunj. By the way, thank you for having me on your show.
No, answer
So
the
we've
Saurabh
been,
Mukherjee question. It's a very logical question.
sorry,
It's a
sorry,
very
sorry.
logical premise of Saurabh Mukherjee, and we are not getting into a debate here. I'm just curious to understand what Saurabh is saying. Is very logical. 1/3 of the total cloud opportunity has only been implemented in terms of transformation. These companies are
Agree.
growing; they don't need cash. 8 to
Right.
10% growth is going to come back, and that is a decent area to be in.
So exactly. Actually, Nico, the point was that only the valuations which went through the roof for IT guys because of COVID was mainly on the back of the fact that this growth of mid-single digits is going to go into 16, late teens kind of growth, right? And that's why the valuations went on to, for the large caps I'm talking about, is 28, 30 times and forward earnings and stuff like that. Yeah. Now that obviously came to a knot after COVID went away, right? We're not saying that it's a long-term trend that we're looking at, but now look at it this way: that if your growth rates for IT are going to come off from 17, 18 perceived growth rates to your right now, though anyway, Infosys announced a mid-single digit, but even if it's late single digits growth rates, what valuation should you give them? You should go back to what they were pre-COVID levels, right? So today also, they're still around 25% premium to the pre-COVID levels. So that's what our concern was. In fact, when we started removing the names, they were at 40-45% premium to pre-COVID levels, right? And today they're at 15. I think some of them, I mean, the large caps are at 15, 20 odd percent premiums to the pre-COVID levels, but the growth rates are collapsed. Okay. And that's what we're seeing. So as we said, that in the immediate short term to medium term, probably you'll see these IT stocks coming off, maybe not a actual correction in the price, but in terms of time they will take away. And I don't think our markets are gonna be a flatlining market for next couple of quarters. We believe that in fact, that's what again we called out at the beginning of the year itself, that you'll see a bulk of the returns coming in the market in the second half of the year, and that's what we prepared for. So I leave it here.
Okay.
Maybe Saurabh is right. In long term, obviously everything looks good. In India, frankly, I mean, everything in the long term looks very good.
We shall take this conversation forward with both of you. I promise that. But today may just not be the day. Saurabh Mukherjee's got a long day ahead, and he's just managed to squeeze in this appointment. So appreciate your time, Saurabh. Thank you for joining us.
Thank you very much.
But Dinshaw, we are not letting you go. What have you bought last? Simple sawal.
So anyway, Nikunj, I won't tell you the names. Obviously, we've been loading up on our financial exposure. That's definitely going to be there. And our feel is that in fact, just before I joined in, Saurabh was talking about HDFC Bank. And I actually didn't hear him on the cloud bit. So that's why I was clueless when you asked me that question. So good you briefed me on that. But anyway, he was talking about HDFC Bank. And I think that's one of our favorites. I mean, we've been holding it for probably that's the only bank which we've been holding from the day we started our fund, which is Helios Fund in 2005 itself. And we've been, adding to it whenever. And I sincerely believe that this is the one which is going to lead the rally going forward for the banking sector per se. And then, frankly, I mean, it just there'll be a bit of hiccups in between because recently that MSCI came up with the new rule that they're going to apply a factor of 0.5 to it rather than 1 going forward. And so that's why there's some correction with it. But that's one sector that we very gung-ho on. Another sector that we've been fairly comfortable with has been in the consumer space, which is mainly the discretionary consumer space. And again, we're talking about here, which is aspirational discretionary as such. And here again, we did see valuations bloat up a lot at the beginning of the year. Everybody was fairly gung-ho, and we did chop off or pair off a bit of a position in the sense we reduced our weights in these stocks because we saw the P's really bloating up and not getting justified on future growth. And as soon as the stocks came off, we've been adding to those names also. I think going forward, that's another one which is going to be leading the pack. Apart from that, I don't think we added any new names as such. And frankly, I mean, Nikunj, before you ask me that question again about multi-baggers, you never know, right? I mean, when we bought say a Varun Beverages, which was probably a pure soft drinks manufacturer, I mean, franchisee for Pepsi, we didn't realize that it's going to give a return of 70-80% every year, right? So that's what happened with that stock. And frankly, multi-baggers come along that way.
Dinshaw, hi, morning. Curious to know what's the opinion on Mankind Pharma? What a dhamakedar listing. People are still saying it's a buy.
No, I know, Aisha. So our call on Mankind was, in fact, we did analyze it during the IPO time. So it's fairly concentrated. The revenue is fairly concentrated in top 5-10 brands as such. And uh, and frankly, I mean, our feel was that giving such a huge premium to the industry wasn't justified, even though if you look at it's purely a domestic play as such. So even if you look at that factor, it didn't justify that kind of premiums as such. And we stayed away, and we were quite surprised that actually we were not too surprised at the time of the IPO, because obviously the retail didn't like it, HNIs didn't like it. It was the QIB book which built up uh, substantially as such, and that's what pulled the IPO. But the fact was that we were quite surprised at the way the premium shot up at the time of listing. So anyway, we're not in that stock at all. So just leave it here.
So you're skipping it right now because the valuations are rich, or are you going to skip it altogether?
No, obviously the valuations were rich at the time of IPO itself. So obviously the listing has seen it becoming richer. So we'd rather wait it out and look at valuations coming in sync. In fact, that's a call we took during the time of Zomato also. In fact, by the way, this was the stock which has done like given a heavy premium to its IPO price and was the second largest after Zomato. That's I'm talking about Zomato. So we took that call on Zomato also on the day of listing. We sold it off and then stayed away from it for till the time the stock came back to around 40s and stuff, and that's when we started looking at the stock again. So I think I'm not saying that this will collapse this way, but the fact is that we don't think this kind of premiums will be justified. So.
Yeah, but what do you make of this entire ONDC network? Who will gain, who will lose? I mean, today we are all comparing that, okay, suddenly the burger which is coming from McDonald's on the ONDC network is 30 rupees cheaper. That's end of the food delivery, networks or food delivery players in India. Is it true? What do you think?
So Nikunj, actually, I was over the weekend. By the way, 30 rupees is too less price to excite me to get into getting on the ONDC platform. But I actually ordered from one of the vendors who's on ONDC. By the way, I tried to order it from a pure ONDC player. He didn't have any stores in my vicinity. So in fact, he had one store which was in Bangalore. So that was out. But went through one of the other players who was on the ONDC network, and he had, so I ordered a burger, right? It was actually 100 rupees cheaper than what I would have ordered from, say, a Swiggy or a Zomato. But let me tell you how that 100 rupees came about, right? There was a 10% discount offered by the provider, the service provider, on the burger itself. Yeah. There was a difference of some 30 odd rupees on the delivery charge of the burger, right? Now that obviously the delivery charge was pathetic. It was like 8 rupees as compared to 35 for a Zomato or the same for a Swiggy. So it's obvious that this kind of subsidy won't last. And plus, I got a 50 rupee coupon from the service provider. So basically, he was subsidizing, the service provider was subsidizing, wasn't the ONDC network. The price of the burger was the same on both. It was just the discounts which worked out. So it's a matter of time before these guys also come back and say, hey, we can't afford this kind of discount that we're offering. We're just trying to get into this game as such, and that's what's working out here. So I think it's a matter of time. And frankly, I mean, my experience of delivery also wasn't that great. It came through a Dunzo, the delivery, though the gentleman on the ONDC network was not done so. And it came some 50 minutes later. So it was like a pretty cold burger, while the one which I ordered on Zomato came in like 20 minutes or such. So it was fairly warmer than that. So I did my research, and I don't think it's got a long way to go. It's got a long way to go. And till then, obviously, I mean, if you see globally also, there's only two players who really make it big in the hyperlocal space as such. And the way Zomato is going is he's in fact gaining market share on Swiggy. So I don't know how this is going to work out, but I don't think in the immediate term we've got to worry about the ONDC right now. So
Everybody ordering burger. I mean, the most sold thing on food delivery is actually biryani.
Biryani,
Yeah. Then sure, you ordered the wrong thing.
You're asking
Biryani.
the urban consumer, Nikunj, and then you expect biryani as an answer.
No, it's the
I
most.
wanted to make it light on my pocket.
Dinshaw is the urban consumer who buys Metro and all these.
HNI, Louis Vuitton, and
Westlife.
Yeah.
Metro is like downgrade for him.
Almost
Sorry,
FII.
Dinshaw. Sorry, Dinshaw. Aisha, in a sense, was not being frank about the brand affordability and the brand preference of it. Maybe Metro, maybe Louis Vuitton,
I
maybe
just
Gucci.
stopped short of that.
But Dinshaw, speaking of that entire theme, that consumption theme, what exactly would be the outlook? Is there anything that stood out maybe in terms of the kind of earnings, the commentary that we saw from the likes of Dabur, HUL, Nestle, etc.?
So, Aman, the point is that these guys, mainly FMCG guys, it's coming out to be a mixed picture as such, because some of them are saying that rural seems like picking up, the others are quite confused about it. But our feel is that the ones with a higher network in the rural space may be getting a slight advance indicator about the fact that El Nino is playing pretty truant as such, and that's why the feel is that there's been a pullback, not a pullback, rather it's a halt on rural demand right now as such. It's not picking up as much as was expected to be at the beginning of this year. So that's the feel here. But frankly, I mean, on the FMCG space, we're not that excited because we don't believe these kind of valuations can be justified for a single digit or probably a low double digit kind of growth that one will see in this going forward as such. And frankly, if your call is on India, is that our GDP is going to pick up and per capita are going to pick up, it's not going to be the FMCG space which will earn. It is going to be the discretionary space and obviously the finance space which is going to earn. So that's where our more concentration is rather than on this space. Probably QSRs will benefit because they've got a very nascent market and they're still trying to penetrate. One saw the results of McDonald's, Westlife rather, and realized that things are really picking up in that space. They've still not been, because of, even despite the urban slowdown that one is talking about, one hasn't seen it in that space as such.
Dinshaw, you mentioned last time and today also that you expect returns to be in the second half. Guess what? Returns have already come in the month of April and May. So do you think the expected returns of second half have already come in first half, or second half will be even better?
So if you see the year-to-date returns, they're not much, right? I mean, obviously April was pretty good. May has been fairly okay till now. But the fact is that if you're talking about, so basically if you go back in history and last 25 years, India has given a return of some 14% annually as such. So if you're looking at that kind of return, obviously you're talking about, when I say back-ended, if you look at that annual kind of return, you're talking about a massive return in the second half. So we just touched the tip of the iceberg, I believe, even in terms of year-to-date returns. But our call has been also the fact that we've been underperforming the region and the global markets for no reason at all. Our call was that at least this underperformance should turn into outperformance the way one saw in 22 as such. And I think that's what's reversal has happened. FIs have come back in. They've realized that India cannot be clubbed with Asia or emerging markets, and probably you have to look at it separately. And I think that's where the additional flow is coming to India as such. And that's what's helping us out. So our feel is still the same, that we will start outperforming the region. And for India to at least start moving up the chain, things have to stabilize globally, which is looking to be so as such. Even in the US, where there's been so much of upheaval, things are looking a bit more stable now.
Dinshaw, what is the best way, to your mind, for next 3-4 years one should simply bet on consumption? I mean, gone are those days where if you wanted to bet on consumption, you bought HUL and Nestle and Britannia. Right. It really has to be different. For example, you bought Campus, you bought Maneuver. What else for next 3-5 years?
So that's the space actually, Nikunj, because I think it's going to be more aspirational spend. So when you get into when your purse becomes larger, right? I mean, mid-income person, his purse become larger. He won't be looking at taking a bath 3 times a day or brushing his teeth twice a day or thrice a day or something. So it's obvious that FMCG will be not that much impacted by these higher purse spends as such. So you have to look at the discretionary space, right? And within that also you got to look at a space which is an addressable space. So though the consumption base in India is 1.4 billion, but we all know that actually it's 300, 350 odd million, which are really going to make an impact on the discretionary space. So you've got to target that space as such. And that's what we're looking at. And that's what forever we're looking out for ideas within that space per se, which can appeal to this 300 to 350 million odd people who are going to be. And obviously the young population that India is going to be. In fact, recently the World Bank report showed some 200 plus million young people, which is going to be there in India. You can imagine a whole of Europe in one place, young Europe in one place as such. So that's the kind of spends that we're targeting as such. So.
All right, Dinshaw, from Zomato to ONDC to even heavyweights in the tech space, you've really covered it all. So thank you, as always, for being candid and joining us on the show.